In this video, we break down 3 under-the-radar stocks that smart money is quietly loading before March while most investors are still distracted by headlines and hype. By the end of this video, you will understand why these specific businesses are attracting serious long-term capital and how they are positioned to compound value over the next several years. These are companies operating at massive scale inside essential industries that continue to grow, regardless of market cycles. They control critical infrastructure, command durable competitive advantages, and benefit from demand trends that do not disappear when sentiment shifts. These are long-duration businesses with the ability to quietly compound while attention is elsewhere. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's start with the first stock, and this one sits at the core of modern computing, artificial intelligence, and global digital expansion. Micron Technology, ticker symbol MU. Micron Technology is one of the most strategically important semiconductor companies in the world, yet it rarely receives the same level of attention as consumer-facing technology giants. Micron specializes in memory and storage solutions that are essential for nearly every advanced computing system operating today. To understand why Micron matters, you need to understand how computing actually works at scale. Every digital action generates data. That data must be processed, stored, and retrieved at extremely high speeds. Memory is the connective tissue that allows computing systems to function efficiently. Without high-performance memory, even the most advanced processors become bottlenecked. Micron operates primarily in DRAM and NAND memory, which are foundational components used across data centers, cloud infrastructure, artificial intelligence systems, smartphones, automotive platforms, and industrial equipment. As workloads become more complex, memory requirements increase dramatically. This is not optional demand, it is structural. One of the most important dynamics in Micron's favor is industry consolidation. Memory manufacturing is among the most capital-intensive businesses in the world. Building and maintaining advanced fabrication facilities requires tens of billions of dollars, deep technical expertise, and years of operational learning. This creates an enormous barrier to entry. As a result, the global memory market is controlled by a small number of players. That limited competition allows for more rational supply behavior over time. When companies exercise discipline, pricing stabilizes and profitability improves across the cycle. Micron has increasingly positioned itself as a disciplined operator rather than a reckless capacity expander. Another critical factor is the rise of artificial intelligence. AI workloads require significantly more memory than traditional computing tasks. Training and running large models demands high bandwidth, low latency memory that can move massive amounts of data quickly. This has elevated the importance of advanced memory solutions. Micron has invested heavily in next-generation memory technologies designed specifically for these high-performance use cases. These products carry higher average selling prices and stronger margins than legacy memory offerings. As AI infrastructure spending continues globally, Micron's exposure becomes more valuable. What separates Micron from weaker competitors is its ability to invest through downturns. Memory markets are cyclical, and downturns often create negative headlines that scare away retail investors. Smart money understands that these periods are when the strongest companies gain ground. Micron has spent recent years optimizing its cost structure, improving manufacturing efficiency, and aligning capital spending more closely with demand signals. This discipline reduces the risk of oversupply and enhances operating leverage when pricing improves. Financially, Micron has entered this phase with a balance sheet that allows flexibility. The company can continue funding research, development, and capital expenditures without jeopardizing long-term stability. That matters in an industry where technological leadership determines survival. Another underappreciated aspect of Micron's business is diversification. The company serves multiple end markets, including data centers, automotive, industrial, and consumer electronics. This reduces reliance on any single customer or segment and smooths revenue over time. Automotive demand is particularly interesting. Modern vehicles increasingly rely on advanced memory for driver assistance systems, infotainment, and autonomous features. These applications require reliability and long product life cycles, which align well with Micron's capabilities. From a long-term perspective, memory content per device continues to increase. Smartphones use more memory than they did a decade ago. Data centers use exponentially more. AI systems push those requirements even further. This creates a powerful tailwind that compounds over time. Smart money accumulation often begins when near-term earnings are still pressured but forward indicators improve. In Micron's case, inventory normalization, stabilizing pricing, and accelerating AI demand suggest the cycle is turning. Institutions position early because they understand how quickly sentiment can shift once results improve. This is not a business that needs heroic assumptions to work. It requires steady demand growth, disciplined supply management, and continued relevance in advanced computing. Micron checks all three boxes. The key takeaway with Micron is that memory is not a commodity to be dismissed. It is a strategic asset in a data-driven world. Companies that control high-performance memory infrastructure sit in a powerful position as digital transformation accelerates. This is why long-term investors continue to quietly build positions in Micron while headlines focus elsewhere. They are betting on compounding relevance, not short-term excitement. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second stock, and this is a business that many investors prematurely wrote off because they misunderstood where long-term demand is actually heading. Western Digital, ticker symbol WDC. Western Digital operates at the foundation of the global data economy. While the market often fixates on faster processors and cutting-edge software, none of that matters if the data itself cannot be stored efficiently, securely, and at scale. Western Digital specializes in exactly that problem. To understand why Western Digital matters, you need to step back and look at how data is created and used. Every AI model, every streaming platform, every enterprise application, and every connected device generates enormous amounts of information. That data does not disappear after it is processed once. It must be archived, replicated, backed up, and accessed repeatedly over long periods of time. Not all data requires ultra-fast access. In fact, the majority of global data prioritizes cost efficiency and reliability over raw speed. This is where Western Digital's core business becomes indispensable. High-capacity storage solutions remain the most economical way to store massive datasets at scale. Western Digital operates in an industry with unusually high barriers to entry. Designing and manufacturing reliable storage hardware requires decades of engineering expertise, deep supply chain integration, and long qualification cycles with customers. Hyperscale data center operators do not casually switch storage vendors. Once a platform is validated, it often remains in place for years. This creates sticky customer relationships and recurring demand. Even when capital spending slows temporarily, storage infrastructure must continue to expand as data volumes grow. That underlying demand trend has not changed. One of the most important misconceptions about storage is the idea that newer technologies eliminate the need for traditional solutions. In reality, different storage technologies serve different roles. High-performance memory handles active workloads, while large-scale storage systems handle long-term data retention. These layers work together, not in competition. Western Digital has positioned itself as a leader in high-capacity solutions designed for cloud and enterprise environments. As data centers scale, even small improvements in cost per terabyte or energy efficiency translate into significant savings. Customers care deeply about these metrics, and Western Digital competes aggressively in this space. Recent years have been challenging for the company, largely due to cyclical downturns and inventory corrections across the technology sector. However, these periods often create opportunities for patient investors. When weaker demand clears excess inventory, pricing power gradually returns. Western Digital has been taking steps to streamline operations, manage costs, and improve cash flow resilience. This operational discipline is critical in cyclical industries. Companies that survive downturns with their competitive position intact often emerge stronger. Another factor attracting smart money is optionality. Western Digital holds valuable intellectual property and deep manufacturing expertise. As data growth accelerates due to AI adoption, storage requirements increase not just in volume but in sophistication. This creates opportunities for product differentiation. Cloud providers are once again signaling increased investment in infrastructure. AI workloads generate enormous datasets that must be stored, labeled, and retrained over time. This creates sustained demand for large-scale storage systems that prioritize durability and efficiency. Financially, Western Digital's valuation has reflected a great deal of pessimism. Long-term investors often look for businesses where expectations are low but fundamentals are stabilizing. Early signs of demand recovery and pricing discipline matter far more than short-term headlines. This is not a story about rapid growth, it is a story about relevance. Storage remains a non-negotiable component of the digital economy. Western Digital continues to play a central role in that ecosystem. Smart money does not wait for perfect conditions. It positions when the risk-reward becomes asymmetric. In Western Digital's case, downside risks are increasingly understood, while upside potential improves as demand normalizes. For investors willing to think beyond the next quarter, this type of infrastructure business can quietly generate significant long-term value. Boring businesses often make the best investments when they are misunderstood. Now let's turn to the third and final stock, and this one operates outside traditional technology but is just as essential to long-term economic growth. Sterling Infrastructure, ticker symbol STRL. Sterling Infrastructure is a specialty construction and infrastructure services company focused on projects that support population growth, industrial expansion, and digital infrastructure. While it does not generate headlines, it benefits directly from some of the most powerful secular trends shaping the economy. To understand why sterling matters, consider the physical backbone required to support modern life. Data centers, transportation networks, water systems, energy facilities, and industrial sites all require highly specialized construction expertise. These are not discretionary projects, they are foundational. Sterling operates in niches where technical complexity, regulatory requirements, and execution quality create meaningful differentiation. The company focuses on projects where its experience allows it to deliver reliably and profitably rather than chasing volume at the expense of margins. One of Sterling's strengths is disciplined project selection. Construction can be a risky business when companies take on poorly structured contracts or overextend themselves. Sterling emphasizes risk management and margin preservation, which has led to consistent improvements in profitability over time. Another key driver is exposure to data center-related infrastructure. As cloud computing and artificial intelligence expand, demand for site development, foundations, and supporting infrastructure increases. Sterling benefits from this trend without taking on the capital intensity or operational risk of owning the facilities themselves. This position allows Sterling to participate in growth while maintaining a relatively asset-light profile compared to heavy industrial operators. That improves returns on invested capital and enhances financial flexibility. Sterling also benefits from long-term infrastructure investment driven by demographic shifts and modernization needs. Population growth requires expanded transportation and utilities. Aging infrastructure requires replacement and upgrades. These forces create steady demand across economic cycles. Financially, Sterling has demonstrated improving margins and a growing backlog. Backlog provides revenue visibility, which is particularly valuable in construction. It allows management to plan resource allocation and investors to assess future earnings potential with greater confidence. The company maintains a conservative balance sheet, which reduces financial risk and provides optionality. In uncertain environments, balance sheet strength often separates survivors from casualties. Smart money accumulation in Sterling reflects recognition that infrastructure spending is not a short-term stimulus-driven theme. It is a multi-year priority supported by both public and private investment. Companies with proven execution stand to benefit disproportionately. Sterling's business is grounded in tangible work with contracted customers. This reduces reliance on speculative demand and enhances predictability. Over time, that predictability supports steady compounding rather than volatile swings. Unlike highly leveraged infrastructure plays, Sterling's disciplined approach limits downside risk while preserving upside exposure. This balance is attractive to institutional investors seeking durable returns. When you step back and look at these three stocks together, a pattern emerges. Each operates in a critical layer of the economy. Memory enables computing. Storage preserves data. Infrastructure supports physical expansion. These layers reinforce each other and grow together over time. That is why smart money often builds diversified exposure across them. To fully appreciate why Sterling Infrastructure belongs on a smart money watchlist, it is important to zoom out and look at how capital actually flows during long economic expansions. Physical infrastructure rarely captures investor imagination, yet it absorbs enormous amounts of capital over time. Roads, utilities, logistics hubs, and digital infrastructure must all be built before growth can occur. Sterling sits directly in that path. What makes Sterling particularly compelling is that it operates in segments where execution quality matters more than branding or scale alone. Many construction firms compete primarily on price. Sterling competes on reliability, technical capability, and repeat relationships. That difference shows up in margins and backlog quality. The company has steadily shifted its portfolio toward higher value work. Rather than chasing commoditized projects, Sterling prioritizes opportunities tied to long-duration demand drivers such as population migration, industrial reshoring, and digital infrastructure expansion. These trends do not reverse easily even when economic conditions soften. Data center-related infrastructure remains one of the most attractive end markets. Every new facility requires extensive site preparation, utilities, transportation access, and structural work. Sterling participates at this foundational level, capturing value without taking on technology risk or exposure to hardware cycles. Another important element is geographic exposure. Sterling operates in regions experiencing strong population and economic growth. These areas require continuous investment in infrastructure to support housing, commerce, and industry. That regional focus provides a natural tailwind. Financial execution has been equally important. Sterling has demonstrated an ability to convert revenue growth into margin expansion. This indicates disciplined cost control, effective project management, and pricing power. Over time, incremental margin improvement compounds meaningfully. The balance sheet remains a strength. Low leverage allows Sterling to navigate downturns without being forced into unfavorable decisions. It also provides capacity to pursue selective growth opportunities when competitors are constrained. Smart money favors businesses where management aligns capital allocation with long-term value creation. Sterling's focus on return on invested capital rather than headline growth reflects that mindset. This approach may not generate excitement, but it builds durable shareholder value. When institutional investors accumulate shares quietly, it is often because they see a long runway with limited downside. Sterling fits that profile. It operates in essential markets, maintains financial discipline, and benefits from multi-year investment cycles. Now let's step back and connect all three businesses. Micron, Western Digital, and Sterling Infrastructure operate in different sectors, but they share a common characteristic. Each provides essential infrastructure that supports modern economic activity. These are not optional services. They are required for growth to occur. Micron enables computing intensity by supplying the memory that allows data to move quickly and efficiently. As artificial intelligence expands, memory requirements increase. That demand compounds over time. Western Digital preserves the data created by those systems. Without reliable, cost-effective storage, the data economy collapses. Long-term data retention and management remain critical functions. Sterling Infrastructure builds the physical foundation that allows digital and industrial expansion to take place. Data centers, transportation networks, and utilities all rely on skilled infrastructure services. Together, these businesses represent different layers of the same growth engine. They benefit from secular trends that extend well beyond the next quarter or the next year. Smart money often builds positions in these types of companies during periods of relative disinterest. By the time narratives shift and headlines turn positive, much of the upside has already been captured. That does not mean these stocks are without risk. Cycles exist, demand fluctuates, execution matters, but the underlying relevance of these businesses remains intact. Long-term investing is about owning companies that matter, companies that provide solutions the world cannot easily replace. Micron, Western Digital, and Sterling Infrastructure each meet that criterion in their own way. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to ask you a question. When you compare Micron, Western Digital, and Sterling Infrastructure, which of these businesses do you believe has the strongest long-term competitive advantage, and which one would you feel most confident holding through multiple market cycles? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.